CarMax just hired a hotel executive to fix its stalled sales engine, and apparently his very first order of business was, well, hacking prices to get cars off the lot. We are jumping into Earnings Unscripted today to look at CarMax, ticker KMX. It is April 14th, 2026, and their fourth quarter numbers just hit the wire.
Right, and it's quite the strategic pivot. Real quick, though, just as a disclaimer, this is strictly our personal opinion and absolutely not financial advice. But yeah, the market violently rejected this report today. The stock dropped 15.24%. Selling triggered right alongside the 9 a.m. earnings call, gapping down into the 44s and just bleeding out all afternoon.
Yeah, it was a brutal tape. And when you read the headline numbers, it almost looks like a paradox, because revenue actually grew, right? It hit $5.95 billion, up roughly 2.6% from last quarter. But then you glance at the bottom line and they swung into this massive loss, negative 85 cents a share compared to a 43-cent profit in Q3.
Sure, but that bottom line hit it's mostly accounting gravity. They had to take a $141 million non-cash goodwill impairment because their market cap collapsed over the year. If you strip that out, along with a few restructuring charges, adjusted EPS was actually a positive 34 cents. I think the much more structural story here is the margins. Management intentionally shrank their retail gross profit per unit down to $21.15. That is a noticeable 5.4% drop.
Right, and they spent the last couple of years protecting those per unit margins at all costs. But Keith Barr, the new CEO, he comes from the hospitality industry. He used to run IHG hotels. So he seems to be approaching this like an occupancy problem. You have to put drivers in seats, even if it means taking a hit on the daily rate.
Yeah, exactly. They essentially decided to sacrifice margin to buy volume, which used to be sacrilege in the sector.
No, but that's exactly the issue. They had to do it. I mean, consumers are just exhausted right now. The only way you move metal in this environment is by literally lowering the sticker price. And to be fair, the strategy worked. Retail unit sales grew almost 7% quarter over quarter to over 181,000 sold.
It did work. They successfully bought foot traffic, but they achieved that largely by tilting the inventory. Management admitted that about half the cars on the lot right now are Value Max vehicles, which is a very clever corporate term for older, high-mileage cars, the kind you buy when you just need a reliable engine without completely wrecking your monthly budget.
Exactly. It is a live snapshot of an affordability crisis playing out on a dealership lot. You have shrinking margins, higher volume of aging cars, and a new CEO trying to rethink the whole purchasing process. All right, let's get into the details and see what this actual strategy means for their cash flow going forward.
Well, if you want to look at their cash flow going forward, it really comes down to the mechanics of these price cuts. They aren't just, slapping a generic discount on every windshield. Tom Folliard gave a pretty incredible explanation of their retail math on the call.
Oh, right. The whole psychological pricing model.
Exactly. So they reported that retail margins dropped by an average of $200 per unit. And naturally, the assumption is that they just shaved $200 off across the board.
And nobody notices a $200 cut. I mean, if a car is $20,000 and you make it $19,800, that doesn't actually trigger someone to pull the trigger and buy.
Yeah, because practically every sticker price they use already ends in $998. It is a locked retail anchor. So Folliard actually told analysts, and I will quote his exact phrasing here, "We're more likely to drop a car $1,000, like 20% of the cars, $1,000 to achieve the $200 price drop."
That is so surgically aggressive, though. They are essentially looking at this massive sea of inventory and letting an algorithm identify exactly which cars are rotting on the lot.
Right. It is pure algorithmic triage. They take a chainsaw to the 20% that aren't moving to free up capital. But here is where the strategy gets genuinely risky. If you are aggressively scraping the bottom to hit that affordability floor, you are naturally attracting a much weaker consumer.
Right, and they have to finance those consumers, which is where CarMax Auto Finance comes in.
Yep, and this is the part that actually surprised me. They are pushing hard into subprime right now.
now, the top half of Tier 2 lending. Their VP, John Daniels, said they were less than 10% in Tier 2 a year ago and closer to 20% this quarter.
Wow. So they doubled their subprime penetration in 12 months just as the average consumer is tapping out?
And Daniels literally added, "We look forward to taking on that volume."
But wait, in their own filings, they pointed out that their older loans, like the ones they wrote back in 2022, are currently seeing elevated default rates because of inflation. So they know the consumer's cracking, but they are stepping up to take on even more risk?
Yes, because they are stuck. They can charge a massive interest rate premium on those Tier 2 loans, which is highly profitable over time. But the flip side is they have to set aside cash immediately to cover the expected defaults. They took a $73.9 million loan loss provision this quarter alone.
Okay, so that explains why the auto finance income dropped almost 18%. They are eating the upfront cost of the risk just to facilitate the volume.
Exactly. They are subsidizing their own sales growth with their balance sheet. And honestly, I think they know it is going to be a bumpy year, because if you look at their share repurchases, it tells you everything about how management really feels.
Oh, the buyback freeze. They just abruptly turned off the tap.
Yeah, they bought back over $630 million in stock this past year. But in Q4, they spent barely $50 million and then just paused the program completely.
I mean, logically, if your stock drops 15% in a single day and your business model is perfectly sound, you back up the truck and buy shares. The fact that they paused it means they are actively hoarding liquidity.
Absolutely hoarding cash. The CFO, Enrique Mayor Mora, warned everyone that the margin compression isn't over. He expects the first quarter to have an even worse retail margin squeeze. He actually guided it closer to a $300 per unit year-over-year decline.
Jeez, $300 per car just evaporated from the profit line. No wonder the market punished them.
Right. And my absolute favorite part of the whole report is how they're trying to manage the optics of this. It is a very clever piece of corporate misdirection. They are officially changing how they report their operational costs to Wall Street.
Let me guess. The old metrics stopped telling the story they wanted to tell.
Precisely. They have always communicated their SG&A efficiency as a percentage of gross profit. But if management is intentionally shrinking gross profit to win back volume, your cost structure suddenly looks incredibly bloated.
Or worse, it looks like you completely lost control of your expenses.
Yes, exactly. So the CFO announced they're transitioning to an SG&A per total unit metric. They dropped the profitability anchor and replaced it with the volume anchor. So as long as they keep moving metal off the lot, their cost metrics look perfectly healthy on paper.
Okay, yes, but that is doing a lot of heavy lifting. It feels almost like a magic trick to hide the pain of a deflationary price war. They hired a hospitality executive who wants to make buying a car take 5 clicks instead of 10, but they're funding the whole experiment by taking on subprime loans and just praying the volume offsets the margin loss.
That is an incredibly accurate summary. It's an asset-heavy pivot, and they're essentially building the parachute after they already jumped.
So looking past the absolute wreckage of this specific quarter, where does this actually leave them heading into the rest of the year? Are we looking at a permanent structural change for CarMax?
I think it has to be structural. The old model of holding on to premium pricing while your volume just craters is clearly broken. So they are essentially punting the big vision until June. That is when Keith Barr is supposed to reveal his comprehensive strategic plan.
Right, because right now we just have these kind of fragmented survival moves, like taking the penalty to dump that underutilized Edmunds office lease or, well, squeezing out more cost savings. They actually bumped their SG&A run rate savings target up to $200 million by the end of fiscal 2027.
Exactly, but that is just trimming the fat. What actually fascinates me is the psychology of the new leadership. Barr had this quote on the call that is, strangely poetic for a used car earnings report.
Oh, I love poetic corporate speak. Hit me.
He said, on the surface, hotels and used cars may seem different, but at their core, both businesses succeed by delivering the right product at the right price.
Okay, fair. But I mean, if I get a bad hotel room, I just sleep terribly for 2 nights. If I get a bad subprime auto loan, I ruin my credit score for 7 years. So it is a little different.
Yeah, slight difference in stakes. But his point is really about digital friction. He wants the purchase process to feel as seamless as picking up a keycard. If he can execute that, it actually changes their operating leverage long term. If he can't, then they are really just becoming a highly leveraged lender selling high-mileage cars.
That is quite the tightrope to walk. It feels like investors probably just need to sit on their hands until June. We really need to see if this whole hospitality approach can move metal profitably.
Precisely. The math just has way too many loose variables right now. Let the dust settle.
All right, we will see if the magical 10-click car purchase actually becomes a reality. Thanks for hanging out and making sense of the noise with us today, everyone. Catch you after the next call.
If you enjoy having these drops just magically show up on your device, you can always hit follow to keep them coming. And just as a quick transparency note, we do use AI tools to generate the audio here, which is really the only way we can compress hundreds of pages of filings into a quick afternoon chat. We always love hearing what you want us to look at next, so toss your ticker request to earningsunscripted@datamadness.ca or catch the X link down in the show notes.
Catch you next time.